points away from yesterday's low with the 60-point cut now. Varun Goel is with us. He's Senior Fund Manager, Equity at Mirae Asset Investment Managers. Varun, good afternoon. Good to have you with us here. Thank you for your time. What's getting you interested in the markets, Varun? What sectors, what themes, and what's keeping you busy?
Good afternoon, Prashant. Thanks for having me on the show. Currently, how we are looking at the markets, we are more positive on secular growth stories like IT, pharma, consumption. These are some of the sectors that we have been adding incremental positions. Chemicals also looks like we are coming out of almost 2 years of poor performance, and it looks like things will get better both from a margin and profitability perspective. So these are some of the sectors that we believe can do better. We are currently a little cautious on cyclical names, especially on the defense, railways, and auto side, where we believe valuations have run up quite a bit, and therefore maintaining a slightly cautious stance on that side.
What do you like in chemicals? How should one best play the chemical recovery?
I think one has to be more selective. I think as far as the agrochemical space is concerned, we are still seeing some challenges, both from an international and a domestic perspective. But I think some specialty chemical companies, you have to go chemistry by chemistry in terms of where the Chinese supply has been easing off, where we are seeing revival of margins. And as such, that is where we are finding some opportunities. I think EV space and battery chemicals as a space should see very, very strong growth for the next 3 to 5 years. And that is definitely looks like something where we can find a few ideas to invest.
Okay. Varun, great to have you on. Where do you stand on the EV debate? And if you like the theme, if you think that it has a lot of potential, then what's the best way to play it? I mean, then you have this one pure play EV player. A lot of the OEMs are scaling up, and now we've just got an announcement from a completely different entity. I mean, Easy Trip Planners, which is not even in the auto space. So a lot of parts to it, but how would you play the EV theme, and do you like it at this point in time?
Well, I think if you look at the broad auto space, there is no doubt that there is going to be disruption. We are going to move from the earlier technology, which is ICE, to EVs, hybrids, maybe who knows what all other powertrains do come along. I think the valuations of the automobile sector has run up very, very dramatically in the last 12 to 18 months. So we'll be a little cautious on the OEM names. I think tractor seems to be one space where things seem to be turning around, and we might see growth getting better, especially in the backdrop of good monsoon. So that is one space that one is a little more positive on. But I think both OEMs and ancillaries, we have seen very, very strong price performance, and therefore, I would be maintaining a cautious and underweight stance at this point of time. I think specific components like battery chemicals was one space where one has to really pick and find opportunities where where there is capital efficiency, where balance sheets are clean, and where managements are doing a good job. But broadly, would be cautious on the automobile space.
Auto, defense, rail, right? I mean, essentially, what you're cautious on right now. Well, again, when we say consumption, Varun, what could you narrow it down a little bit? What kind of names?
Yeah, so I think discretionary consumption as a space continues to do well, while we continue to be on the lookout for recovery as far as the stable space is concerned. But I think some sectors like travel, tourism, we continue to see good traction. I think companies in the hotel space, hospitality segment, even leisure and amusement parks, I think incrementally as purchasing power per capita incomes increase, this is one space that we see better days ahead. Also, I think discretionary consumption related to children, whether it's stationary items, whether it's bags, water bottles, luggage, wherever children have a major say, I think all those categories are seeing very rapid expansion in growth. And that is where we see next 3 to 5 years should see very, very strong and above average earnings growth to play out.
Good idea to bet on kids. Varun, I mean, I can't say no to kids, right? Just a quick word on, you said two things actually. One is you said hotels, hospitality. Do you own Lemon Tree? Again, I'm not asking for stock advice, but if you can just talk about, I mean, stock's seen a fair bit of damage. It's a very large chain, hotel chain, with I think the second or the third largest number of keys across the hospitality, the hotel space. Any thoughts at all?
So unfortunately, Prashant, I won't be able to comment on stock-specific basis, but I think broadly, as I was saying, we believe that tourism and hospitality will remain a large space. I know we have seen historically from the Asian example, as per capita incomes increase from $2,500 to $5,000, there is a significant increase in spends on these items, and we would be constructive on the space.
And amusement, you said amusement parks as well, right? So there aren't that many out there, but you think it's a good business?
Yeah, absolutely. I think so today if you see an average family of 4 can spend 8 to 10,000 rupees on a single day's outing. As per capita incomes increase, there are a lot more Indian families which will be able to spend that kind of money. So broadly, I think whether it's resorts, hotels, or eating out, and some of these amusement activities will definitely see much more traction, much larger pots of money being invested in this space, and we would remain largely positive on that side.
Hi Varun, good afternoon. Good to see you, Ben. What are you making of the cement universe? It's been a horrid time in terms of pricing, but now it seems the industry, they have come together. They are like, let's fight back on the pricing front, and input costs have been cooling off as well. So in the last, I think, 2 or 3 trading sessions, the street is taking note of this. Otherwise, you get a price increase which gets sold into. Now we are in the monsoon and prices are not correcting. How are y'all approaching that? Will y'all go with the large cap names, or will y'all go with the smaller names like in Orient, Nuvoco, that could possibly be taken over?
I think broadly, if you look at the cement space, we have seen very difficult times from a pricing perspective. I think next 2 years we are going to see significant amount of supply coming in. And I think the industry as a whole has been trying to increase prices, but finding it difficult to do that in the short to medium term. The sense is that once the monsoons are over, Q3, Q4 are supposed to be strong quarters. There is a lot of money which is going into capex, and the private capex, which is the residential housing, seems to be doing well. So one hopes that the demand should come back in the third and the fourth quarter onwards, and hopefully next year, FY26, we should see cement companies doing quite well from a profitability perspective.
Varun, what are your thoughts on the housing finance segment? You've got the more expensive ticket size companies like an LIC, Canfin, PNB, and then you've got affordable housing companies like Aadhar, Aavas, Aptus, Home First Finance. But all of them have had a very good asset quality. It's not exceeded, 1.5 or 2% in terms of gross NPAs, and growth has been fairly strong. And now you've got big boy Bajaj Housing Finance opening up for subscription, next week. So do you like the housing finance companies? If yes, which segment would you play?
Yeah, I think broadly we remain quite constructive on the residential real estate upcycle. I think we are still in the middle of the cycle, and we expect this cycle to have more legs. At least next 2 to 3 years should be quite strong. So from that perspective, all companies or players in that space, whether it's builders, whether it's building material companies and housing finance companies, all of them should benefit from a very robust demand. I think if we look at the sector, we are seeing 13 to 15% kind of a credit growth, which looks quite strong, and we believe this can sustain going forward. Of course, valuations in some pockets have run up quite a bit, so we would be a little careful in terms of some of the smaller housing finance companies. But I think largely from a medium to long-term perspective, this remains an attractive sector to invest in.
Talking about discretionary spending, what about beauty and personal care? So yesterday, Nykaa had that beauty summit, and they spoke about the Indian beauty market hitting $34 billion of size by 2028. So the opportunity is massive. And we were talking to a few analysts, and they're saying discounting has come down. One of its competitors, which the street was fearing will eat into, say, a company like Nykaa, hasn't scaled up to that extent. So, do you think this beauty personal care category is going to, is attractive as an opportunity?
Well, I think overall, like I said, all discretionary consumption items, especially those items which become more affordable as incomes increase, definitely should do well. I think as a category, definitely there are, this category should also do well. Now, what is the best way to play this? That's something one has to really pick and choose. But broadly, yes, the category should do well from a medium-term perspective.
All right, Varun, we leave it there. Thank you very much for your time. It's a pleasure having you here on CNBC TV18. Thank you for